Our market monitor tonight says investors who are really long-term owners of stocks should not be scared of a little market volatility. He's Marty Leclerc, Chief Investment Officer at Barrack Yard Advisors. Mr. Leclerc, welcome. Good to have you with us.
Thanks, Tyler.
How can I insulate myself against the natural fear of volatility? When things go up and down a lot, as they have this past week, it starts to feel a little risky.
Well, the thing that people have to realize is that volatility and risk are not the same thing. Mr. Market will tell you that your shares are worth a certain amount of money on any given day. But the key is time horizon. If you have a long-term time horizon, then it just becomes noise.
All right.
You are a big proponent of buying stocks, and you are again putting out a warning that not a good idea to be in bonds or anything that is tied to the interest rate world. A lot of our viewers still think that bonds are a safe place to be. Give us your case of not to own bonds.
Investing has so many paradoxes associated with it, and right now, because of the zero interest rate policy of the Fed, safe investments or investments that are traditionally thought of as being safe are paradoxically not safe. The Congressional Budget Office, the CBO, estimates that by the year 2019 that we'll probably be back in a normalized interest rate environment. If that's the case, then 10-year Treasury bonds will be yielding 5%. And those of us who've lived for a while don't think that 5% is a particularly high interest rate. If that were to indeed come true, then people who currently own long-dated assets tied to the cost of money, like REITs and preferred stocks and long-term bonds, would see somewhere between a 30 to 40% decline in the principal value of their investment.
Boy,
it's just simple math.
That really nails it right there. It tells you how much you'd lose if interest rates go up by that much. To your point, that what seems safe sometimes can be very risky. Let's go to some stocks now, Marty, quickly, beginning with one you like that has not been doing much over the past decade. That's Cisco. Why do you like it now?
Valuations. First of all, we like their business. They're an entrenched incumbent participant in the global IT infrastructure, which is a very good business. The business has a decent and high return on invested capital. But it's valuations, Tyler. Cisco right now is trading on a free cash flow yield of about 10%. And in addition to that, they are very, very strong financially. They have $5.60 of net cash per share. So really, the global economy can throw a lot at them, and they'll still be okay.
Marty, let's move along to your next one. You like DuPont, DD on the big board. What do you like about it? The stock has had a nice move so far this year.
Right. I don't know if I'd be chasing DuPont at these levels, and we're not particularly, I would say, bullish on the stock market right now. We are a little bit wary. But the thing that's great about DuPont is that it's a way to participate in two major themes that we see. One is the rise of the global middle class and the accompanying boom that will be for global agricultural companies. And not very many people know this, but DuPont owns the largest seed company on the planet. It's called Pioneer Hybrid. And the seed business is a wonderful business. It has enormous barriers to entry, and there are only 4 major companies who basically control the market. The other way that the other trend that one gets exposure to by owning DuPont is America's energy independence that's being as the result of the shale revolution. And the important thing is that companies like DuPont, which are big consumers of energy, for their American business, will have a competitive cost advantage relative to our trading partners.
A little short on time, Marty. Thank you so much. Have a great weekend. Do you have any disclosures to make on those 2 stocks you mentioned?
Yes, I own both of them.
Well, that's a clear disclosure.
As do my clients.
All right. Thank you. Marty Leclerc, Chief Investment Officer at Barrack Yard Advisors.